Welcome back to another episode of the Wealth Blueprint. I'm excited to introduce Jordan Sims from Her Financial Help. Jordan really specializes in getting with families and helping put them on a budget that is meaningful and useful to their financial life, helping them save. And today she's going to share a lot on best practices, how to avoid some financial pitfalls, and how to really put yourself in a position to grow financially and invest money for the long term and for the financial health of your family. So with that being said, I hope you guys enjoy this episode. Here is Jordan Sims. Jordan, thank you for coming in today.
Yeah, of course.
So I'll be a little bit descriptive here, but what's the difference between a financial advisor, a financial coach, and a bookkeeper? How do you define that?
Yeah, so starting at the bottom, I would say is like a bookkeeper is just going to go over transactions and give you a report.
You put them at the bottom. Bookkeepers.
I did say that, and I didn't mean to say that. All
you bookkeepers out there, you're at the bottom of the totem pole.
I would say the least involved.
Yeah.
Which is also silly because they literally do daily transactions. But
yeah, it's more transactions.
Yeah, they're going to categorize your transactions. They're going to give you a report. Most bookkeepers will give you like a monthly report that just says, here's your income, here's your expenses,
here's your P&L.
Here's your categories.
Right.
We're done. Some will give you some feedback, especially if they're also helping you with taxes. They'll say like, hey, you can spend more here or you need to spend less here, etc. But it's usually all revolving around taxes. Then the other end of the spectrum, I would say, is the financial advisors. Those are the people that have securities, they have licenses, they've taken exams. They manage your money in a way that makes you hands off. There's also fees involved. Typically, they take a percentage of a portfolio. They are not helping in the day-to-day. They're helping with the large chunk of money that you've given them, like as a portfolio, as a pile for them to manage. They're going to grow it, but they don't care what you're spending monthly as long as they're getting their deposit or they're just managing what's already in a portfolio.
You're being very gracious towards financial advisors.
I told you.
I think they're
be nice.
I think they're useless. I think they sell you funds that are front-loaded with fees, and then they collect a percentage of your balance under management for the rest of your life, and I think it's kind of ridiculous. So, I mean, it's like attorneys and real estate agents. It's like there's, less than 1% of them are worth their salt. And so I wouldn't say that the whole industry in general needs to be thrown out, but just be very careful who you follow. And if it's like a Fidelity or an Edward Norton or somebody, or Edward, what is it called? Edward Jones.
Yeah.
They'll sell you just like funds that they're sponsored and that they have like higher fees.
Higher commissions. Yeah. Higher commission rates off of.
And it's typically like an ETF or a mutual fund or, a bond fund or something like that. In my opinion, you'd be better off just buying the S&P 500 and letting your funds sit there, and you don't have to pay any commission for that.
You can also do it yourself. And if you're going to do like the set it and forget it way, where you're depositing money like monthly, weekly, however you want to do it, you're depositing a chunk of money and it's just going to grow, but you're not actually you're not actually picking stocks. You're investing in a fund that's already set for you, and then it's going to grow over time, but you're not going to be paying fees for someone to open the account and look at it or not.
Yeah.
And then when it's down, they go, well, that's just how the market goes.
Right. And most people don't understand that. And we talked a little bit about this when we were talking before we started the podcast, but financial advisors have no advantage in the market. Mm-hmm. They are not day trading your funds.
No.
They're not calling up Tim Cook at Apple and reading their financial reports and making a bet on their next fiscal quarter. Mm-mm. Which is why they're selling you mutual funds, ETFs, bond funds, because that takes as much risk out of it as possible. Those funds are put together by larger conglomerates, and then they attach a fee schedule to it. So your financial advisor is literally a salesperson for that fund.
Yeah. Or worse, they're selling you annuities and life insurance.
Oh, yeah, don't get me started.
Yeah, we're not going to open that box.
So define, because I think what you do is fascinating. I think there's a tremendous amount of value added to people as a financial coach,
Mhm.
I also love that the way that you work, and you can expand on this a little bit more, is your goal is not to be in their life for the rest of their life, charging them money
Yeah.
as a fee.
Yeah.
Right. So
Not unless they want me to.
yeah. So explain what you do and how financial coaching is a little bit different.
Yeah. So financial coaching, the way I've set up my business, and I modeled my business after several other financial coaches that I follow, that I've gotten to know over the years, from what they, learning from other people's failures. The way that I start out is I want to look at your daily finances. We're not going to get too deep in the beginning as far as like looking too far. We're not like, I want to know your goals, but like, I want to know, what are we doing today?
Just an assessment of like,
Yes.
What are your current habits?
Yes.
What do we need to clean up?
Mm-hmm.
Yeah.
Our first, past the discovery meeting, like once we're actually working together, our first assignment is I make you go pull 3 months back. You're going to pull all of your, like literally money comes in, money goes out, wherever it is, I want to know about it. And then I comb through it, and then we have a meeting that's like, hey, here's where you're spending money.
Mm-hmm.
And I give you the good and the bad, like, hey, here's great things that you're doing right now. And then here's the not so good things. And then we make a list of like, okay, we're going to go review. So one of the big things I do is an insurance review. I think everyone should review all of your insurance at least once a year. I do car insurance twice a year because it's 6 months.
And why is that? Just because premiums change so often,
Yeah.
or there's new companies coming in and out of the market?
Unfortunately, we're out of the era of, I don't want to call it necessarily brand loyalty, but that basically is what it is.
Yeah.
I also have a strong issue with captive agents. There's a market and you should be in it.
And captive agents, you mean like an agent that only sells like State Farm insurance?
Yes.
Yeah, versus Progressive.
State Farm, Texas Farm Bureau. I feel like there's another one that I can't think of. Those guys are captive. They can only sell you State Farm.
Yeah.
So when you ask them to review your insurance every year, they reviewed it against themselves.
Right. They're not shopping it to
They're not
find
doing
the best marketplace.
If you go to a broker that has the word agency after their name, which you can see, State Farm will use the same thing, but State Farm agency, when really that's not what they are. But a broker is going to be able to shop multiple places.
Right.
So like, for instance, my parents have a insurance agency, and they can shop, I think, like almost 20 different companies.
Yeah.
Their website is like a scrolling logo system with like all the places they can quote. But when they run your insurance, they're not running one, they're running it against 8 to 10 different companies for any one given line item.
And people don't understand, like we do that in my mortgage company too. Mm-hmm. We're a mortgage broker. So I can shop your loan to 200 different lenders depending on if it's commercial or residential, and then your credit score and your debt service coverage ratio and all those things. People don't understand that the change in daily delta is so significant in payment premium.
Yeah.
Like 0.25% on an interest rate or 0.25% on your premium that you commit to over the next 12 months is a huge payment difference. Yeah. So creating that competition between providers is huge. I mean, I think that's a great way. So,
and it should be that way for just about anything. I mean, even your health insurance, you can shop, especially if you're self-employed and you're shopping like the marketplace, or you're shopping private like PPOs or anything like that. Like we can shop multiple different places and get you the best bang for your buck, whether that's you're paying more for more coverage or you're trying to, skate by and get the premium as low as possible. Because the other thing is that you want to know what you're covered for. Like you want to know your deductible. You want to know your out of pockets. Like what are you actually spending money on?
Right.
And know what you're spending money on.
Yeah.
I'm fine if you want to pay more for a lower deductible. Just know that's what you're doing, and know that you can also do the opposite.
Right.
You can raise your deductible and lower your premium if that helps you out.
Totally. So so you're doing the assessment. You go back through 3 months of their finances, their credit card statements, where they're spending money. Right.
Yep.
What are like some of the most common bad habits that you see when you're looking through people's finances that are like just kind of like everyday oopsies, but also like this is repeating itself?
Yeah. I would say I could sum it up in probably 2 to 3. The biggest number one is overspending generally.
Just spending more than you're bringing in.
Yes.
Deficit spending.
Yes. Yeah. People don't know how much they're making, and they oftentimes have an inflated idea of what they're actually making. You can see that in W-2 employees. You'll have people that are like, oh, well, I make $1,900 a week.
Yeah.
And it's like, okay, but then there's taxes, and then there's premiums that got taken out, and then there's, this other thing that was withheld. And so, okay, now you're only bringing home $1,300.
Yeah.
And then when the $1,300 comes in, now what are you doing with that cash wise?
Yeah.
But in your mind, you made $1,900.
Right.
Opposite is true for 1099. You'll have a big number come in, and you'll be like, hey, I've got, I had this client place invoice, say it's $2,000. Okay, whatever invoice company you used is taking a subscription fee. So now what actually got deposited in your account is maybe $1,900. And then now you have to save taxes because you don't have an employer saving taxes for you.
Right.
There's also expenses like all of your subscriptions that you're just using for your business.
Mm-hmm.
So that number gets smaller and smaller. But in your mind, you had a $2,000 invoice paid.
Sure.
And so just pretty much across the board, people think they make more than they make.
I used to call that like the doctor problem.
Yeah.
Like when I was in private banking, we had so many investors that were doctors and attorneys that made really good money. I mean, you're talking like, 700, 1.2 million,
mm-hmm.
right? But it's all through billing, right? The attorneys doing it through billing, the doctors doing it through billing.
Mm-hmm.
They all thought that they were financially invincible and had zero like discipline and spending.
Yep.
And so when we'd go to do their loan, or they would come to me for investment advice, and we'd like be looking at where to place their funds, I'm like, you realize that you have, $120,000 going out every month, and you're bringing in 95.
And they don't.
Yeah, and we can't
and they
find
don't.
it. And they're like, well, I make this much. And I'm like, well, your upside, your debt service coverage ratio is negative.
Yeah. You can find, and there's several books out there now about millionaire studies, but you can find millionaires at any income level because it has to do with spending habits,
right?
Not income.
Yeah,
income is going to get you there faster, but if you spend $1 million, you're still at net zero.
Right, and you're not building any wealth if you're spending more. Okay, so. And that seems like, how much of that's like a psychological thing you have to solve when you're talking to them?
80%.
Yeah.
80%. If it was a math problem, we wouldn't be in it.
Right.
There would be fewer people with money problems if money was really a math problem.
And how do you address that with the client? Is it different with everybody? Or
it is. Yeah. It depends on your emotional relationship with money. If you have a positive relationship with money growing up, you may or may not have a positive relationship with money in your adulthood because it might have been too easy for you as a child. So the idea that like money grows on trees, I can always just make more.
Yeah, like dad's always paying my credit card bill.
The opposite is true for broke or poor individuals that grew up in a poor or broke household. When they come into money, they're used to spending everything they had. So now they continue to spend everything they had because they've never had enough to save, so they never have the habits of saving.
It's like a famine mentality of like, I have bread, I have to eat the whole loaf, instead of like parsing it out over the next 30 days.
So the balance is finding why are you spending money? What do you feel like you need to have? Some of it is a posture thing. Yeah. The fancy car, the bigger house, the keeping up with the Joneses, that's a very real thing.
Yeah.
We live in a world that's instant gratification, so we finance everything. You can finance things on Klarma for like $4 a month for the next 6 months.
Oh my gosh.
Why?
Yeah.
And then you do that month over month over month, and now you're paying Klarma or whatever, PayPal, a $300 bill every month, and you don't even know what it's for at this point.
Right. It's like that saying, like, how you do anything is how you do everything.
Yes.
So you're, like, if you take out the Klarma, is it called Klarma?
I think it is. It's like
something like that. If you're financing stuff you can't afford, you're not doing that one time.
No.
You're doing it several times over several years, and then you don't even know. Yeah. So, and I also think that there's like a, mental connection with spending money that releases endorphins.
Absolutely.
Right? And so that could be the problem too. It's like, I don't even need anything, but I'm awake at 2 a.m. I'm not taking care of my body. I'm not sleeping.
Yeah.
But I think if I buy this thing through HGTV, then it's going to make me feel a little bit better tonight.
Unfortunately, it's a double-edged problem because there are also psychological studies that show that the less attached you are to the actual representation of paying for something with real money, the less it's a negative feedback in your brain.
Right. So it's on a card,
it's a double win. You're not getting the negative I spent money because you did it on a card that you didn't even pull from your wallet because you've saved it on your Apple Pay, Google Pay, whatever on your phone.
It's never been easier to do that.
Yes.
Like you get an ad on Instagram, you click on buy now, it's checking you out with your wallet that's saved to your iPhone. You're not, and then it's scanning your face and authorizing the payment in like 2.5 seconds.
And 2 days later, a package shows up, and then you get more endorphins for, oh, look, my new thing.
Yeah.
So it is a double whammy. So that's why I encourage everyone. I don't mind budgeting tools at all. I use an online budgeting tool myself that pulls my bank into one place and I categorize it quickly. But in the beginning, I want you to see it as much on pen and paper as possible. I do spreadsheets, but I want you to go through. We're physically going to look at every transaction.
Yeah,
because
make them connect to how it's real that you guys are spending.
Something else that companies are doing now, like Google, like Apple. I go through people's transactions. I'm like, do you realize you have 12 Apple payments coming out? That means you have like subscriptions inside apps or something that you have authorized that you don't even like. Half the time I'm like, do you know what that is? And they're like, no.
Yeah, and it's not one big thing, but it's like $10, $12 monthly subscriptions. I mean, that's groceries for a week.
It is.
Yeah.
It is.
So that's the number one habit you have to solve. Obviously, that's probably the most glaring, right?
Yeah.
Like you're spending more than you're bringing in.
Yeah.
What's a couple of other habits?
Spending in categories that may or may not be unnecessary. So a lot of times that ends up being self-care is really big right now. And so it's like the Starbucks, the get your hair and your nails done, having a tanning subscription. Even I'll go so far as to say the gym membership. Like, yes, if you're an actual gym person who's going 2 to 3 times a week, you can keep it. But a lot of times people just have it on there because they're going to go.
Right.
But they're not going.
They hit like New Year's Eve, January 1st, like I'm signing up.
Right.
And then it's 6 months later, they are not using the gym membership. Yeah.
Some other ones, again, financing things that you should not be financing. And that ends up happening because that adds over time. Again, you've got the gratification of you've gotten the item, but you're still paying on it. And so you're still in debt to yourself. You still, and that's another thing is like having a clear picture of your debt. People, once they have the item, a lot of times forget about the debt that's still attached to it.
Yeah.
So for instance, the car, it's like, oh, that's my car. Nope, that's the bank's car until you pay it off.
Pay it off, yeah.
And if you don't pay it, they will come get it because it's theirs and not yours.
Yeah.
Same thing with house. Same thing with even like your phone. I mean, nowadays we don't buy our phone, we finance it for 36 months.
Right.
And so it's very common for you to just forget how big your debt bill is. And so then they look at, oh, I have this discretionary income. I can go do something else with it. And then they finance something else.
Right.
Or
because they're still like net positive in cash flow, for instance, but they're accumulating debt.
Yes.
And they haven't paid off the things that they're enjoying 6 months prior, right?
I would say
you don't need you don't need the inflatable outdoor swimming pool right now. Why'd you buy it in November?
Right.
Nobody's gonna swim in that thing until June or July.
The other thing is looking forward. Like, I have a lot of people, and we were talking about this before, but like, you get someone that gets a bonus. You get someone that gets their tax refund, super big. Everyone gets their tax refund, right? What do they go do with it? There's a reason car sales are the highest in April.
Right.
Because they take that money, they go put it on a down payment, and they buy a new car. They trade in their old car.
Right.
But when you have that influx of cash, some people are digging themselves out of a hole. Some people are counting on that to get back to positive. But then also, if they have it, they're like, oh, that's all extra gravy. But they're not looking 6 months, a year, 4 years, 10 years down the road.
And they bought the new truck with a higher monthly payment.
Yes.
And it starts
all of that. One of my favorite things to do is to take a calculator and show them what like $100 investment looks like in 10 years, 20 years.
Yeah.
Versus
the art of compounding.
Your
$100 compounded for what, 20 years is like 1.3 million or some version of that.
Yeah, I play with
it's $10 billion. No.
Yeah, $10 billion. Yeah, but
I also think
but seriously, because they go, oh, I have $100, I'll just go get a bigger truck payment.
Right.
I'll go get a bigger, I'll finance a I don't know, a camper, whatever.
Right.
You're
then
gonna
that camper sits next to your house or in your storage unit.
And you're just slowly, it's the keeping up with the Jones, but it's also lifestyle creep is another word we talk about. You're going to upgrade your wardrobe. You're going to upgrade your house. You're going to upgrade the decor. You're going to, whatever. I just bought a new rug, but it's like this.
Did you finance the rugs?
I did not.
Okay,
I
good.
paid cash. And I also sold my entertainment center to buy the rug.
There you go.
So I have $0 transaction.
I have a rule in my household. I actually got this from Donald Trump. This is not a political statement at all, but when he first got elected, he was talking about regulation in the financial markets. And he said, we have so many regulations and so many of them overlap. He's like, for every new regulation that we adopt, we need to get rid of 2 old ones. And
do you have a 1 in, 2 out policy at your house?
I have a 1 in, 2 out of my policy. We're not as good about it as we are other times, but for the most part, it's like, okay, you want a new pair of shoes, you have to get rid of 2 other pieces.
I have a 1 in, 1 out. Maybe I should up my game.
Well, I have 3 little kids with grandparents that send in lots of toys and stuff to our house. They like to spoil my kids. And so I won't allow my kids to get new things unless they, like even this weekend, my 6-year-old went through our toy bin and she filled a whole garbage bag of it so we could donate it. And then I'm like, I'll take you to the store and get you 1 new Barbie because you got rid of all those things.
How fun.
And that's just like a little fun. But so like when we're talking about like creating good habits, so you've identified bad habits, right? Then your goal is to put them on a path for success.
Yeah.
Right? And I'm assuming most of this, we talked about this a little bit, like most people graduate high school and don't know how to balance a checkbook. No one's taught finances, and unless your parents, I think you benefited from that, I've benefited from that, like being in a household. My dad was an engineer, so we talked about financing. He was very like OCD about all of that.
Yeah. You had a spreadsheet dad.
I had a spreadsheet dad. I had a whiteboard dad.
Oh, I had a whiteboard dad. He has a very large whiteboard.
Yeah. My chores were on whiteboards. So like I'd
know if our chores were on. Actually, there was a time that there were literal dollar bills, like magnet clipped to the chore.
Yep, that's exactly.
I remember that.
Mine was a little bit different. I had a whiteboard, and then here's all the chores, and then next to that was the privilege that I would lose if I didn't complete the chore. So it was like cell phone bill or can't drive your car for a week or like whatever. So a little bit different. He was more stick than carrot, but it worked. And it gives you like a mental connection to the responsibilities that you have and then the money that you're spending for the lifestyle after you've taken care of the things at your house, right?
Yeah.
So what are habits that everyone can adopt now? Or maybe you're talking to someone that's 16 or 25 or 35, and no one's gotten this education yet. What are good habits you can start today to put you on a better pace?
The number one thing is understanding the value of $1. And I'm not talking about it from an economic standpoint. I'm talking about your time equals making money. Mm-hmm. That money that you go and spend is equal to a certain amount of material things. And you can't just make more material things without making more money, which means you have to turn time into more money at a basic level. So knowing where money comes from, I think is very important to teach children. They have to understand that, no, we're not going to go get all of these new toys because all of these new toys, there's many reasons why you don't need them, but one of them is they cost money.
Right.
And we're not just going to spend all of our money all of the time to do all of the, to just spend money. We're not doing that.
And there's no connection with, like, they didn't earn the money to do it. It just shows up. The doll shows up. Whatever. And
same thing with like taking care of things. Yep. Like we're teaching our children to take care of their toys right now, because taking care of their toys is going to lead to taking care of their car, which is going to lead to taking care of their schoolwork, which is going to lead to taking care of their clothes and their home later in life. But it's starting right now with taking care of the toys. When a toy breaks, unfortunately it's broken and we can't always fix it. And if we were going to fix it or replace it, that again costs money.
Right.
But understanding that at a fundamental level is big when you're an adult, when you realize, oh, this stuff costs money.
Yeah.
And I have to make money to have the life that I have, and I need to take care of my things. We have to be stewards of what we have and take care of it for it to last. A part of being a good steward is also the number one thing is always spending less than you make. If you are spending more than you're making, you will never make it out.
Yeah.
And money doesn't solve all of the problems, but it solves a lot of them.
Yeah.
And that's one of the things I don't know. I probably say that to my clients like every other call.
Well, I think that's like a real damnation of our culture in a lot of ways. I mean, like fast food, you know, there's no mind-body connection with what you're putting in your body. It's just like what's quick, what's easy, what tastes good.
Yeah.
You know, that's why drive-throughs, I mean, the fact that you can just like drive through a building and eat 3 times your daily caloric intake and it costs $20, that's the problem, right? It's like you don't have a connection to that. Whereas if you go to the grocery store, you pick out, you know, high valued protein and vegetables and fruits, and then you have to go home and you have to cook those things. Yeah. That's the connection. It's like very similar with finance. I think you said something too in the pre-interview that I thought was really great about like going to the gym. What did you say? You said debt culture.
Oh, I was talking about that having good financial health is similar to having like health and wellness, just like in the fitness world. Yeah. That we can go crazy and make a diet that's uncomfortable.
Yeah, crash dieting. That's what you're talking about. Yeah.
And you're gonna drop it. The same with a budget. If I make your budget or you make your budget uncomfortable to the point that I'm not saying that you're not going to hurt for a little bit, because sometimes you have to have a slap in the face that's like, no, we got to cut the spending. No, we have to pay off the debt. No, we have to, we have to do these things that are uncomfortable, but it's always for a season. A problem that you see in the diet culture is like the crash dieting, like you're talking about. It's like, I'm going to go crazy. I'm going to cut out all my sodas. I'm not doing sugar. I'm not doing, taking someone who has all of those things on a regular basis and then tomorrow switching the like turning it off. Yeah. The same with finances. If I strip all of your fun things, you're not going to last 6 months. Right. And you're not going to actually learn anything that's going to change any type of habit that's going to make a year or 5 years from now look any different than it does today. Yeah. And I think that's really important to understand that, like, obviously finances are a journey. We're not going to know everything from day one. And also, most people, I'm not saying there's not people who get windfalls of money, but most people don't ever get a windfall. If you don't wake up one day and have $10,000 dropped in your bank or $100,000, from a grandmother who passed away, then you're the only one that's going to be able to change what's happening in your day-to-day life to make tomorrow look different. Right. And it starts with just little habits like that. Like, nope, I'm not going to go get a drink today. No, I'm not. I had a wake-up call, for myself when I was doing daily transactions, and I added up how many times I got my 32-ounce Dr. Pepper. Yeah. I was like, that's like $60 to $100 a month that I'm spending on just random snacks.
You think about that. So I kind of went through that. I mean, when we were talking about the culture and like avoidance culture and like instant gratification, that is part of the problem, because how easy it is to finance like high interest rate credit cards and finance things that you purchase, and then also food. And, saying this again, how you do anything is how you do everything. When you sit down and you look at how much money you're spending on drinks. Yeah. You go out to a bar, even if you go out once a week on Friday nights with your friends, that's hundreds of dollars a month. Daily Starbucks, $10 a pop every day of the month for 30 days, right? If you just cut those, like, you don't have to live in a shanty and not spend any of your money to be a little bit more disciplined. Yeah. It's like, if you go back to health and wellness, it's like if you go to the gym 7 days a week, but then you eat like trash afterwards. It's not going to give you the results that you want. You can make all the money, you can go do all the work, but if you don't like discipline yourself to complement that, it's like a path for destruction. And it doesn't happen overnight. I think what you're talking about also is like this is years of bad habits that build up, and then it's like, man, I need to pull the ripcord and get out of this. It didn't happen overnight. You're not going to get out of it overnight. And the only way to like be fit and healthy is to have a lifestyle and a discipline that you can do for 30 years. That's manageable. If you want to go out and have a cocktail every once in a while, go do it. If you want to have a steak and, French fries and a hamburger, that's fine. Do that once a month, whatever. If you try to crash diet that person or put them on, hey, don't go spend any money. You can't get your nails done for 6 months or whatever. Yeah, the thing is the mental association with that. And I think the beautiful thing about what your philosophy is and what you're building is like, I want to build a healthy habit for your home that you can execute reliably and consistently over the next 30 years. And if you can do that, then we're talking. Now we're building a plan. And so what is that switch that you see with people? So you've treated the patient, you're understanding where their mental connection is with money, some of the bad habits that they have. You're showing them, a couple small tweaks that they can make to get back on track, pay off their debt. Yeah. What is that moment like for you when like the light bulb comes on for them?
It's probably the best part when they see something that's like, oh, like that, like I get it now. I think one of the biggest misconceptions with budgeting and with a plan is that it's restrictive, when it's actually the opposite. A budget and a plan give you freedom to spend. So like you're talking about like not getting your nails done for 6 months. I didn't say you couldn't get your nails done for 6 months. I said you have to choose that you're going to spend that money on your nails this next 6 months instead of something else. Yeah. But that's okay if you want to do that. It really is okay. But you're going to know that you're making that choice to spend that money on your nails, to go out to eat, to do whatever. But it's going to be in the budget. What we're not going to do is say, I'm going to spend $500 on eating out this month, and then you spend $800. Right. Because then that was $300 that was supposed to go somewhere else that now can't because you chose to go eat out more than you said you were. Right. But I didn't say you couldn't go eat out at all. Right. Because again, that's no fun. Yep. And if we're not having fun, if we're not enjoying life, then what's the point? Right.
That's the same thing with like health and wellness too, right? Like you don't like that Brian Johnson guy, that's like anti-aging. Have you seen him? Yes, right? Yeah. What is the point of living until you're 120 if you're the most boring human on the planet and you're not doing anything?
You're living in a bubble.
Just like, what's the point of me being so financially restrictive on myself that I'm not like enjoying, like you want to enjoy the fruits of your labor. Yeah. Right? Yeah. But you're enjoying them too much right now. Mm-hmm. Okay. You're financially obese and we just have to get you back in better shape and then you're going to be happier for longer. So you get that light bulb moment. I can't talk. You get that light bulb moment and they've agreed, okay, I'm on track. I want to do what you're telling me to do, right? So 6 months later, let's say they're in a better financial position, a lot of their debt's paid down. They're living those daily habits and those monthly habits that you've introduced to them. What's next? What do you do after that?
So I have 2 programs. One is a shortened version. A lot of just personal finance ends up doing the shorter version where we're just looking at budget, savings, debt, and savings can be short-term and long-term goals. If you do the 6-month version where we dig a little deeper, a little longer, then we start looking at what investments do you have or what do you want to get into? What does retirement look like? What does investing into your children's life as they grow past college, what does that look like? And then what does estate planning look like? Like, what are you planning on leaving? Who are you wanting to leave it to? How do you want to, with what's left over at the end, where does it go? And what would make you happy at that point? While also trying to reach a goal that you can retire. Or work less, because a lot of people don't want to stop working because they're like, what am I going to do with my time? Right. But you don't want to be working like you're working now, necessarily. And so a lot of it is actually sitting down and getting to look at what does life look like in 20 years. Yeah. A lot of it is dreaming. A lot of it is the goal planning. But I think what happened to a lot of our parents is there was a lot less planning. It was a lot less living in the day, less planning for the future, because our parents are kind of the first generation that doesn't have the securities of a larger social security, a pension, a company that they worked for 40 years that's going to take care of them. I mean, they had multiple careers along the way. And so if they didn't save for retirement, then a lot of them are still working. And so if we want to do something different, we have to do something different now. And so part of not working in the future means you have to be saving for today. So what does that look like? What part of your budget, what part of your life do you want to maybe scale back, or do you want to scale up your income to like have extra disposable income to put towards saving in different aspects, whether that's investments, whether that's just putting it, like I said, into a kid's fund that's funding their college or helping. I love the 529s now that get to roll over into a Roth, which if it's been open for 10 years, they can actually withdraw up to $10,000 for a down payment on a home. I think that's fantastic.
Yeah. And the way that Roth works, just that's post-tax dollars that you can put into an account. So the 529 plan is also post-tax, right?
Yes.
That can be used towards education expenses.
Yes, but the rules have been expanded because we have a culture that's trying to go back towards the blue collar. Like we pushed everyone to college, and now we have a bunch of college graduates who can't do anything. Like they can't work in their fields because there's not enough jobs, but they're also not skilled enough to go do something else.
They also got like political science degrees or like women's studies or whatever.
Right. Yeah. So you have all these college graduates that now, like I said, that don't have jobs in their fields. And now they had to go learn a trade. So one of the things, like you can go to trade school, you can get certificates, you can do like your insurance license, but like the real estate broker, anything that is a course that also that gives you like a certificate or a certification or a securities license or something like that. All of that can be funded with a 529 at no penalty. Also, your living expenses during that time. So you can pay rent with it. You can buy gas. You can buy food with that 529 money without penalty when it's used during that time of like education, and then also the education.
And that's powerful too, because like if you start a 529 plan when your kid's born, the benefit of the 529 is that it's post-tax dollars, but you don't pay taxes on the gains while it's in the 529. Right?
And you don't ever, and you don't pay. You can withdraw. Another misconception: you can withdraw any money at any point that you put in penalty-free. So, like for example, we have a set amount each month that we pay for our kid, for each child. If something were to happen to them that we needed to withdraw a large sum of money, any money that I put in, I can get out at any point. And I can use it for anything. At the point that they are then using it for educational purposes, which a lot of private schools also are eligible. So when you put that money into a 529 and you're using it to pay for a K through 12 private education, then or education at all, it can also be used for that. It's just sometimes that doesn't really work unless a grandparent set it up or it's a rollover. Because you can also pass them down. So like if a parent has one, you can pass it down to a child. Or a grandparent can set it up for a child. But then at the point that anything's left over after, you use it for college, or say they didn't go to a 4-year college, they just do like a 2-year associates, or they get like a like an electrician, they go and get their trade, some sort of trade school, and it doesn't use all of the money. Then like I said, they can roll the rest of that into a Roth IRA. And as long as the account's been open longer than 10 years, they can withdraw up to $10,000 and use it as a down payment on a first home. And that's powerful because we were talking about it before, but like stepping into the real estate market, the sooner you can do that, the sooner you can get your first home, the better you are going to set yourself up financially. Because that was the point. Buying our first home was the point where we went from negative to positive net worth. In an instant. And that's not always possible because sometimes it doesn't, appreciate
that's also
that
where
fast.
Most of like Americans' net worth is. It's like 90% of your net worth is in your primary residence. And we were talking about that a little bit too, because, depending on where you are, you I think do this very well, is you're assessing the person on like meeting them where they are.
Yes.
Right? If they're 25 or 55, your plan has to be different. If you were like a one-size-fits-all financial advisors, they do this all the time. Your plan and your risk tolerance at 55 is way different than when you're 25. And so you shouldn't be doing the exact same thing.
Yes.
Shouldn't be buying the same fund.
Yeah. If I have
you don't need a mutual fund when you're 25.
Right.
But if you have, millions of dollars in net worth or cash or whatever, your plan's going to be completely different. And I think one thing that's really important, like you said, on buying your primary home, what do you do? How do you generate wealth and build your net worth up when you've saved $25,000, you've saved $50,000? What's your coaching to them? How does that? How do you help accelerate?
So a lot of it has to do with the client's risk management, like how comfortable are they, age, like we're talking about, what are their goals, where do they want to go? Because I have some clients that are like, I want to put money somewhere, I want to close my eyes, and I want to open it when I'm 65 and have a surprise.
Yeah, set it and forget it.
Yeah.
Yeah.
And that's great. I love that for them. I tend to fall into a camp where I want to set it and forget it. I want to just do autopilot.
Yeah.
I love autopay. But there are other people who want to be a little bit more involved. They want to take a little bit more risk. They may have more cash, especially the disposable income monthly. It might ramp up to a point where they're like, okay, I have too much. Because my number one thing, especially for W-2, is if you have an employer match, I want you to go grab it.
Yeah, max that out.
Yeah.
Free money.
Yeah. We are maxing out employer matches every day, all day. I never want you to pause that. As long as you're working at an employer, you can lower it. Like if you're putting more in than you need to, and we need to allocate those funds somewhere else for a time, that's fine. But always go get the free money, like you're saying. And then my next step is usually a Roth IRA. I want you to go put your $7,000 of $7,500, depending on your age, of your tax-free growth. Go grab that. Go take that, have that sitting there. But again, those are retirement funds that you can't use until you're 65 or plus, depending on when you can withdraw those funds without penalty. And then past that, again, it has to do with like your goals. Where do you want to put that, and what do you want to do with it?
Yeah.
Obviously, if I meet a young person who doesn't have a home, that's going to be our first goal. Whether that's working with an investor, or not an investor, but working with an agent that we can work on, like the first time home buyer, we can get a reduced down payment, whether that's like a USDA loan or they're a VA loan. But also just educating them on what do loans look like, what do house loans, and then also what does your credit look like? What does your credit history look like, so that we can get you eligible to buy a home?
Yep.
And then having a down payment.
Don't, overbuy, your mortgage lender will try to approve you for the max amount.
Oh, the amount that we were approved for was a joke.
And that's just ridiculous. That's another trap that people fall into, right? Yeah. It's like when you buy the new truck. It's like, you should buy the $35,000 2-year-old truck, but you're going to buy the $70,000 brand new truck because the dealership is offering 0% financing for the first 12 months, and that's how they qualified you on your income.
Yeah.
You can't really afford the payment for the same thing with the housing piece.
Huge misconceptions with even just the down payment. People think that they have a 0% down payment. That means they don't have to bring anything to closing. And it's like, there are other closing costs that you have to still have. It's just the down payment gets to be reduced, whether it's 3.5 for a FHA or it's 0 for, special types of loans. But there's other money that you need. And then we're going to turn around and you're going to be a homeowner. So let's not deplete every single penny you have and throw it at your closing cost. And then also, we're not going to max out your budget, because another huge thing that I feel like has a lack of education around is insurance goes up every year.
Right.
Your homeowner's insurance, your taxes, your all of that. Yeah, it goes up. And so people that could afford the home 3 years ago, barely, are now pressed because their
income hasn't adjusted to the level of inflation of those other
exactly. And their tax bill or whatever, their the escrow account is asking them for $400 more a month. And they're like, well, now I can't afford it.
Right.
It's like, well, yeah, because you have too much house.
I tell people that, I mean, I get asked that question a lot. Like, if I only have $25,000 or $50,000, what should I do with it? 100%. If you can qualify, you should use the FHA first time home buyer program to buy a duplex.
Yeah.
If I could go back to being 22 again, I would do that. I bought a single family home instead. It was fine. But, you know, the power of 3.5% down to buy that asset. So you can spend 25 grand, you're going to have a $350,000 property, right? With closing costs and all that good stuff. If you're qualified for the mortgage, let's say your mortgage is $2,500 a month. You're paying the $2,500 a month every month. Then you rent out the other side of that duplex and charge them $1,400 a month to live there.
Yep.
If you apply that money to principal on time with your mortgage payment after your expenses, right? If you have any expenses or maintenance costs or anything like that, that duplex will be paid off in less than 15 years.
Yep.
So now your 25 grand owns a $350,000 asset that has appreciated over the 15, right? Let's just say conservatively it's worth $450,000 at the end of 15 years, right? That sets you up for everything you ever wanted to do. Yep. It's paid off. You can sell it. You can keep cash flow in it. You can refinance it, which is tax-free. So you can pull money back out of that property and use that to buy another property or invest in your business or pay off other debt or whatever it is. It gives I don't think people quite, like when you were saying the connection between where they're spending money and how they're spending money, I don't think people understand that on the value of that compounding return, that with $25,000, you can get so much closer to being a millionaire starting with $25,000.
Yeah.
And if you never bought anything ever again, that nest egg is there, right? Yeah. And the other thing is that I would really tell people to do is we have a relationship with a company called Connect Invest, where you can actually get leverage in real estate and earn a higher level of return, right? And you get to act as the bank. You can lend the money out. Your money is secured against real property in a diversified portfolio, and that company is going to pay you 7.5% to 9% return on your money every year. You can invest in that with as little as $500.
Yeah.
So you don't have to have $50,000 to start doing something. 9% is going to beat the S&P 500. It's going to beat your high yield savings accounts. It's going to, for the most part, unless you know what you're doing, it's going to beat any day trader, across the U.S. on a 30-year basis.
With less time, less risk, and less expertise. Like, I don't 100%. Have, like we were talking about, I'm not sitting there watching portfolio or reports of what's going up, what's going down. I'm not watching the news as to who's making what policy change or this or that or what company is going under. Like, I don't have to watch any of that.
Yep.
I definitely love that. Like we're talking about a lot there's a hole where we're, like I said, like we get out of debt, we have this discretionary income, and then people just start saving it. Once you're past your first home, what are we saving for?
Right.
And then a lot of times, and again, this is going back to the advisors, but talking with advisors, there's a minimum limit. And I joke, if I've saved $50,000 on my own, I probably don't need your help, as an advisor.
Right.
That might be a little cocky, but that's just the way I think.
I think that's so right, though. I think that's so right. I think that most people have this association with that. Like, I think more people should have that sense of confidence. I saved this $50,000 on my own. What I run into a lot is I hear people like, well, I only have $25,000 or I only have $50,000. Yes. And they have this sense of hopelessness. Like, what does it matter if I invest the $50,000? I should just go buy the new truck. The real truth is the difference between me that was broke, that was living in a, apartment with 4 other people trying to build my business when I was in my 20s. The difference between me and you is I saw the value in the long-term benefit of investing and being disciplined with my money.
Yep.
I had no reason to think at 22 years old, sleeping on a couch, that I was going to have millions of dollars one day. It was just dedication to that daily discipline, and not just being like this sense of hopelessness. Like, I only saved 25 grand. I only saved 15.
Yeah.
I bought my first house. That turned into 65. Yeah. Then that goes into the next property. Yeah. You know, like just doing those daily habits every day, I think that's the mental connection that everyone needs to make. It's like, I did this. This is my $50,000. Like, don't be hopeless with it, or think that like the world is just going to keep pressing you down, because
literally any amount.
Right.
And you may not, since you are in real estate, but you would be shocked at the amount of people that I meet that have little to nothing in any type of savings. Mm-hmm. People give, Dave Ramsey a bad name for saying like, you need $1,000 emergency fund. They're like, that's not big enough for anything. I'm like, do you know the amount of people that don't even have 1,000?
Zero. Yeah. I think there was something like 60 something or 70%, you have to fact check me on this, don't have enough money in their checking or savings account to handle any kind of emergency up to like $1,200.
Yeah, anything.
Yeah.
So the idea of just having $1,000 sitting somewhere, like, yes, he gets a lot of heat for that. But like he says, it's not to fix everything. It's just to fix most things.
Yeah.
Or to fix some things, or to alleviate, some kind of issue.
Yeah.
But things come up all the time. And if you don't have any money saved, there is stress. But at the point that you are saving anything, you're already more wealthy than a large majority of even Americans.
Yep.
And that's sad and scary.
Mm-hmm.
But it also shows you that, like, by accomplishing 1,000, 5,000, 10,000, make the goal smaller.
Yeah.
I was joking with someone the other day. My watch suggested I lower my step count because I never hit the step counter that it set for me. And I was like, that's kind of deflating. But I did it anyway. I moved it down. But guess what? Now, 5 days out of the week, I'm hitting my step counts. Now I'm trying to get to it because it's more attainable.
Yep.
So lower your goal. If you can't get to 1,000, make it 500. Once you do 500, you can do it again. Once you do it again, you can do it again.
Yep.
And then you're going to wake up and you're going to have 10,000 in the bank somewhere.
Yeah, that's absolutely right. And the one thing you said that I love that so much is like, when you're in that position, okay, let's say you have no money saved and you're living paycheck to paycheck, and maybe you have some debt, mm-hmm. right? The difference between being in the bottom 25% financially and the top 25% is just that you turned that situation around a little bit and you put $1,000 in savings in your bank. That's all it took for you to get into the top 25%.
Yeah.
That's a superpower, because like I was saying, most people have this hopelessness, but if you can just turn that around a little bit, and you can get the 1,000, and then it turns into 5, and then it turns into 10, and you've built those habits, you'll be in the top 10%, and then you're in the top 1% because you've invested wisely. You've watched your spending. Like it's like watching an Olympic track meet, right? It's like the guy in first only won by fractions of a second.
Yeah.
The guy in last also extremely accomplished, but didn't get anything. He didn't get a medal, nothing. All you have to do is make those little tiny adjustments, right? And get on track.
I heard you say you have little girls, so you probably know this, but I think often of the quote from Frozen 2 where she's coming out of the cave and she's distraught and she's like, I just have to do the next right thing. And it's like, it really does come down to the little decision. Like for me with my Dr. Pepper, choosing to go past the drive-through to get the Dr. Pepper, to go home to get the can of Dr. Pepper, or taking the can in the morning and putting it in my car, because when I know that I want the Dr. Pepper, I'll do the can instead of going to the drive-through.
Yep.
It's like that $2.50 added up. And yes, it's not astronomical, but it's a decision that I chose to make the next right move. So that the next right move that I make will be a little bigger, and we just keep moving the needle.
That's life.
Yeah.
In general, right? It is the mountain is built by one small boulder at a time, being stacked upon itself. That's where
which is the same way the hole was dug.
Right, exactly.
Again, either building, we did not get into the problem overnight.
You're either building a mountain or digging yourself a hole, right?
Yeah.
Yeah, I love it. So one thing I wanted to touch on too is you really connect with women in financial literacy and helping with planning and things like that, right? And I don't necessarily think it's like a gender divide, but I do think that men are much more prone to acquiring wealth because it's like attractive to their female counterpart, right? It shows stability and I can be a provider. So they're a little bit more like in the daily, the bills, the investments, stuff like that. But one thing you said to me, which is so true, and it's even in my household, is like the stay-at-home mom is the one for the most part managing the business of the home, the daily expenses, the utility bills, camps for the kids or sporting events, or like those are all things that add up too. How can you introduce financial literacy at a younger, more obtainable level? And what is it about your connection with women to really help them like come along of like taking ownership of this process?
So I think it starts a little bit from past generations. This is like the male dominancy in being the provider. You can be a provider and be a leader. And a part of that is also delegating where your weak points are. Sometimes that just comes down to, like we were talking about, time. If the husband is outside the home working and bringing in, the money while the mother is a stay-at-home mom, yes, she may have a side hustle. Yeah, she may, work part-time if the kids are at, a PDO or say they're school-age kids. But outside of that, mom being primary parent is going to be, even if not in the daily, looking at finances necessarily like on a spreadsheet, like balancing just the accounting of a house. She's the one that is in charge of every single variable 100%. Category in the home.
And she's the one logging on to the website to sign up for the school program or whatever. It's not, you're not stopping your day as the, full-time employee to go do that, right? So
she's at the grocery store. She's, like you said, signing up for camps. She's the one going out and buying the clothes. And I'm not saying that there's not opportunities where the other spouse gets to do that, where the husband goes out and buys the groceries, or he picks up the clothes or buys the clothes or whatever. I'm not saying that there has to be such gender divide, but in the case where you have a husband who's working and then a stay-at-home mom, that just is the nature. That's the whole reason she's a stay-at-home mom, is because she has the ability to do that, to do those things. Because the home is a business, whether or not we like to think of it that way or not.
I think if you don't think of it that way, you're just like, you're a fool.
I mean, it has all the same bills that a business has.
And it's 24/7.
And it's 24/7. It does not shut down.
There's no lunch break. There's no days off.
So I think a woman in the home, even if she's working, has to be in her finances. I believe that all married couples should have combined finances. There should be transparency between the spouses. That doesn't mean that my husband knows every time I go to Sonic. Now, he sees my Sonic cup at home, but he doesn't know every single time I spend every single dime. We do have spending money that he spends what he wants on his money, or with his money, I spend what I want on my money. But our combined finances, we have transparency on every single level of what our money is coming in, coming out. Another thing for accountability is we have a spending limit that I can make decisions outside the budget up to a certain point. We set a dollar amount that's like, okay, if we're making a purchase over this, we have to talk. We have to say, hey, this is what's happening. This is what I want to do. Is this okay? But that doesn't mean, from our larger budget meeting from the month of just, hey, we have a budget, that doesn't mean that like I have to approve the $250 I spent at United, because that's already accounted for in the amount of money we've decided we're spending on groceries for the month.
You don't want to feel like you guys are like being dictators over each other.
And we're not trying to nitpick.
Dude, I can't, I've never understood that with people keeping their finances separate, for so many different reasons. But one of the reasons really, like I have like 30 different business accounts, right? My wife doesn't have access to all of my LLCs or corporations. Just I have partnerships and things like that. But I discuss it with her, and like our household finances, we discuss and go through together. But I think one of the most important things, like the disconnect too, and I want to hear your opinion on this with married couples. they have never sat down and put together their financial goals and plans as a couple. You have two individuals, and that it's even more exaggerated if you're keeping your finances separate. It's like that that's like risk mitigation that you guys aren't going to stay together.
Yeah.
Right? That's such a transformational process. Like just to sit down and talk with your wife or talk with your husband about what is our goal when we're 65?
Yeah.
What's our dream together that you both need to buy into? Because two individuals traveling their own path without any intersection is recipe for disaster. At some point, that's going to blow up, right? How do you manage that with them when you go into, a husband and wife situation? How do you bring that congruence in place? And what are some of the hurdles, not that you're giving marriage advice, but what are some ways that couples can do a lot of this stuff on their own in preparation for sitting down with you, or building that relationship together? Because that's really what it is. It's a commitment to we're in this together.
Yeah.
We're going to decide on our budget. We're going to build a plan together, build our dreams together, because we're in it, for the long haul. Yeah. So what are some things that married couples can do? And then what are some stories you can tell about going into that situation and being we got to adjust this?
Yeah. So I strongly advise the one in, one out. We have one account that comes in and one account that goes out. And then together you decide, you allocate what your spending money looks like on a monthly basis. Mm-hmm. It kind of looks like an allowance, but at the same time, it's nope, here's your money at the beginning of the month. You spend it as you wish. Spend it, save it, do whatever you want. It's yours. You can go make whatever decision you want with it. Mm-hmm. But the rest of the money stays in the household accounts to be used for the family goals. That can look like saving for a vacation. That can look like saving for, a renovation to a house. That can look like buying a toy. It can look like whatever you want it to look like. That's part of the beauty of having a personal finance. Personal finance is personal, but it needs to be together. Because if you're not together and you're only paying the household budget, for example, you meet a couple and they have completely separate finances. And then I've seen it two ways. Either she pays some of the bills and he pays some of the bills, and generally it's split down the middle, or they literally split the water bill was $100, you pay $50, I pay $50 every single time.
Yeah.
I've seen it both ways. Some people find it easier to do one over the other. Some find it more fair to do one or the other.
What's the most effective way?
All of it.
One in, one out. Yeah.
All of it goes in, all of it. The money, personally, the way that we do it, all of our money comes into one account. We have a different account that all of the money exits. But all of the household bills, literally every bill, gets paid out of joint money. It's not my money, his money. It's our money.
Yeah.
It's our family's money to do what we do.
Yeah.
We've allocated each month out of our budget money to spend that's literally my money, that I can, go buy this, go buy that, whatever. And he has the same.
Yeah.
But the rest of the money, I'm not splitting hairs over what the electric bill is each month and how much that's coming out of mine versus his, especially when you have spouses who don't make similar amounts.
Yeah.
If you have a high earner and a lower earner, splitting 50-50 is not fair.
Yeah.
Because one person's getting a better end of the deal.
Right.
Same way with doing she pays the bill, she pays the water bill and I pay the mortgage and she pays the what.
Yeah, it's just a foolish endeavor.
What are we
doing?
It's
also a selfish endeavor. I think, when you first get married too, there's this you're clinging to the things that are yours. Even when you're talking about furniture, it's
it's that's my couch.
I've had that couch for forever.
That's my couch. That's my,
God, the faster you get over that, especially men out there, I'm talking to you guys, the quicker you just decide, this is my family's money.
Yeah.
We need to build this plan together. Everyone needs to be on board. And you stop hoarding that and clutching your pearls of this is, I earned this money.
Yeah.
Or using that as leverage over your wife. That's so silly.
At the point that you got married, whether it was a big ceremony, no ceremony, whether it was
$500 justice of the peace. I saved.
I did not do that.
We bought a house instead of
I did the big wedding. But it doesn't matter. It doesn't matter if you're religious. or not. If you are, you've made a vow and a covenant even before God that you are one. If you're not religious, you still have chosen that one person out of literally everyone in the world.
You still made that vow, actually.
You've
whether you're religious or not,
but you've made that vow that you've picked that one person to be more important than any other person in the world. Why would we not join everything that we have? Because the idea that two are better than one, and we're going to go farther, better together,
absolutely,
than we are as individuals. Why are we still? I mean, I think Dave Ramsey called it roommates. Like, you're living at your roommates. Like, if we're living together, that's what I did with my roommate in college. We had the bill. Our rent was like $1,100. We split it. $550. You pay $550. I pay $550. Why would I do that with my husband? Why would I split my finances down to the like literal penny?
You're missing the forest through the trees. You're missing the life. And you're idolizing money instead of the life that you should be building together as a family, as a husband and wife.
And then when you're looking at savings and goals, where is that going? Who has it? Who's managing it?
She's coming with you.
Making sure the other person isn't. Exactly. So who's making sure the other person is still holding up their end of the deal? Like, I have met some people that they open up a third account and they're like, well, we both add money over there. And I'm like, okay, but do that in reverse and do it with your spending money. It's a whole lot simpler, I promise. And then when you see it all together, like the goals that you get to see when your money is like literally sitting in a giant pile together is so much greater. It makes more sense, and there's unity in that. Like there's unity in being able to sit down and go, hey, we can go do this fun thing. We can go save for this thing. Or no, that's what we want to go do. What does that look like today? What does that look like tomorrow? What could we sell? What could we, what extra hour, some people can pick up extra hours. Some people can, like for me, how many more clients can I go get? How many more policies could I sell to make these things happen, make these things a reality? I found out a long time ago, I'm not money motivated, which seems so weird considering I have this honestly obsession with personal finance. I'm not money motivated. I'm goal motivated. And so you can dangle all the money in the world in front of me, but if I don't have a purpose for it, I don't go chase it. But you tell me that my kid needs blank, or my car needs blank, or we want to go on blank trip, I will take that. I will divide it by how many hours or how many policies or how many, whatever the math is. I will figure out a way to fund that thing so fast.
I think anything that's money motivated is a fool's errand. I think that if you're focused on adding value and your service first and purpose driven, the money will come if you're really good at what you do.
The money will follow.
But doing and I've made this mistake before too, done a deal because of the profit return, even though I was uneasy about who I was doing the deal with or whatever, never ends well. And if it does end well, it's a blessing from God because you never you should have trusted yourself of this doesn't feel right. I don't want to go into that. Right.
I've signed clients before that I was chasing, not chasing the money to be greedy, but chasing the money because I needed it. I have an open spot. I need to fill it. I need, we're low this month, whatever. I'm going to go do this client just because.
I mean, that's natural when you're an entrepreneur starting something new.
100%. If you don't work well, you're not giving your best and they're not getting your best. And that's,
you're wasting your time.
And that's sad on both ends. Versus when you find people that you work really well with, they work well with you, you work well with them, you have a passion for what's going on in the job, things get really exciting.
You get results.
It's a lot more fun.
I love that.
So it does take a certain point in your business where you get to be choosy, where you don't have to take every offer on the table.
So one thing, it sounds like you get a lot of inspiration from Dave Ramsey. I mean, he's probably the biggest personality in the space. I think fundamentally net positive from the value that he's providing to the public. On the other side of that, there are some things that I disagree with him on. What's your position on just good debt versus bad debt? Credit cards with rewards programs, things like that. Where do you sit with all that?
All of it comes down to responsibility. If you are a person who can handle and manage your money responsibly, then you get privileges. It's just like a child with a toy. It honestly is. If you're misusing the opportunities, then we have to take those privileges away. So, we were talking about before, like Dave Ramsey has to draw a hard line and say all debt is bad debt, which I don't actually know if they 100% say that, but debt is bad to them, right?
They say all debt's bad.
Yeah. So they're like, even, I think they make the exception to the house. I think I heard Dave Ramsey say one time, he's like, yeah, I couldn't motivate people to save $100,000 before they try to buy a house. He's like, I could only get them to save, 3 to 6 months. And so it was a joke that like, even if he could make like mortgages bad, he would, in people's eyes. But when you're talking about good debt, bad debt, I don't have no problem with you using credit cards. We use credit cards. I chase rewards. I chase the sign-on bonuses. That's how we travel. I have never paid for a hotel except when we went to Alaska and they didn't have places for me to use my rewards because Alaska has like 3 non-hotels.
They have dial-up internet.
Right. Yeah. In places I was worried about having internet and a cell phone service. So they definitely didn't have a Marriott. But, like like I said, we use credit cards. We use credit card points. The difference is my like credit card statement is set to pay off in full every single month.
Yeah.
I don't carry debt on my credit cards month over month. At the point that you do, you've lost every single reward that you gained.
You lose all.
And yes, at that point you lose your privileges.
Yeah.
You have to freeze the card. You have to take it away. Go put it in the freezer. Cut it up. Put it in the safe. I don't care.
Yeah.
Cancel it if you have to.
Yeah.
But it's because you misused it, not because it in itself was innately bad. I feel like it's just like any particular like good, bad thing. It's like, well, it wasn't the thing that was the problem. It's your misuse of it.
I think the valuable point there is like the surplus that you can benefit from, right? So like you go back to health and wellness, right? If you're 100 pounds overweight, you don't get a cheat meal.
No.
You have to hit your goal weight.
Yeah.
And then if you want to have a burger and fries every once in a while, you can. Once you get the habits in line with what you're saying, and you can trust yourself to be responsible with the daily finances. Yeah. Go get a credit card. Go use leverage to your advantage.
Yeah.
Like one of the most powerful things to building wealth is actually using leverage, whether you're using it by leveraging stocks or real estate or whatever it is. Yeah. If you have the rest of your house in order, you can take the risk on the leverage.
Yep.
But until then, hit your goal weight and then we can talk.
And it's the idea too of like when you're in debt, like in the quote unquote bad debt, like if you have payday loans, if you have unsecured loans that are that were bailing you out, like a personal loan, say maybe you got a car loan of some sort that was like getting you out of negative debt on your car. Yeah. Car loans, I would consider past one, really even not even the one. I still err on the side of that's bad debt. Your good debt are things that can grow your net worth faster than you're losing the money and the interest. Mm-hmm. And again, that comes with a little bit of math, but it's not bad. I mean, we can count to 10 and we know which one's bigger. And so like if I have an asset that's growing faster than the interest it's costing me, then that gets to go in the good debt pile, especially when it has a whole asset like real estate that you can look at and go, I have a house, I have 2 houses, I have 4 houses. Right. And even though they might all have loans on them, they're still the net positive. Right. Versus if I have 5 truck loans, I don't have enough to pay off the 5 truck loans because my trucks are worth less than I financed.
Is the debt producing cash flow and income? And is that cash flow and income high enough to cover those and put money in your pocket and help you pay for that asset should anything go wrong? If you're buying a property and it's at break even, that's not positive cash flow. Yep. That's anytime, a water heater goes out, you're losing cash flow, right? Yep. So you want to be at a certain level, and that's what we do with our company. We can walk people through that, and we spend probably 20 hours with our clients before we even allow them to buy property.
Wow.
Going through what their goals are. Like that's the thing that attracted me to your company was you're treating the patient. instead of just being like, hey, this is one size fits all for everybody. You're treating the patient in the sense that everyone else has their own reasons for why they want to do something, and we're big on that. What is your why? Why do you want to make money, more money? Is it early retirement? Is it whatever, right? You have to understand that first, then walk them through what the options are that you can add value to, and then present that. We don't charge anything for our services. It's like, this is what we do. I will share it with you for free. If you decide it's a good, step for you to take, I'm happy to help you do that. If not, great. Because like you said, you don't want the client that is resistant to learning from you and buying into, hey, this is the goal I want to be on. And I'm not saying that this is the only way to do it.
Right.
You can make millions of dollars doing something else too, but this is the value that I add. You buy into that, we're going to have a really good relationship. If not, you can go, try it
to whatever else.
In other avenues.
Yeah, exactly.
Well, Jordan, I really appreciate your time. I think that was awesome.
Yeah.
I might have to sign up for your services.
That'll be fun.
Drag my wife in here and no, she's great.
So good. She keeps me in line.
Well, I think one thing too that is interesting. Like, I was thinking about this earlier. Like, if you're in the median income or lower income or whatever, like, you might be thinking like, this is a great option for you to have. Like, I want to get my finances in order and build like my savings and then eventually build wealth. I'm thinking of it as someone that's like, I could not work tomorrow and never have to work again. I feel like I need this more than anyone, because you reach a certain level of success, a certain level of income, where, man, like the first time that I sat down for dinner and I didn't even have to look at the bill and I could just like give them my credit card and pay the bill and I knew everything was going to be okay. That's what real financial freedom felt like to me. Every dollar above that I made was like, it doesn't matter.
Literal gravy.
Just knowing that you're just okay.
Yeah.
Right? But then you, like the creep lifestyle, right? So you buy a bigger house, you get more cars, you do all this, and you can lose track of the importance of the discipline that got you there. And I think that anyone like in my tax bracket or income bracket could really benefit from that too. Even if everything's okay. Just have it like looky-loo.
If you're not looking at your personal finances, I mean, sure, a certain level of income, you could look at it once a year. But if you're not looking at it quarterly at least, you're going to have things that you don't even know you're spending. I have the thing about money problems is it's just like any other thing in life. The same problems that broke people have, rich people have too. They're just different. So like you were saying, like a someone who has to look at their bank account to make sure that they can pay for that meal, the rich person, high income earner, whatever, may not have to look at that, but they're going to have something else around the corner that is going to be a similar problem. But also, if I looked at their, bank statement, and then I showed them how much they're actually spending every time they go out to eat, they might go, "Ooh, I didn't realize it was that high. I didn't realize I was doing that. I didn't realize." And then the cool thing is when you do get to take someone's income, which I had this happen recently, but I got to take a family and I got to go, you're not as bad as you think you are. Like it's really going to be okay. And also, if you make this adjustment and this adjustment, you can do everything on your goals list. But they were living in a mindset of such scarcity that they didn't even want to look, because which could have been, to their fault. I mean, to the fault, it could also be the thing that got them where they were, because they're like, oh no, we're broke. And it's like, okay, but you can breathe now. But at the same time, don't take such a deep breath that then we forget. Like,
I mean, that's just as harmful too, right? Like your stress and cortisol and anxiety is what's going to put you in an early grave too. So it's all combined. I love that, and thank you. We're gonna have you back on too. That was fantastic. Jordan? What's the name of your company?
So my company's name is Her Financial Help.
Okay.
It is not exclusive to women, although I am a woman, and that's kind of how I came up with it. I also believe in financial literacy for women. It's statistically proven that women know less about money upon graduation from high school and college. And so that's part of my mission, I guess you would say, is helping women learn about money. So yeah, I think my tagline is her place to learn about money.
Okay.
Which is really fun.
Where can people find you?
So typically, you can find me on Facebook and Instagram. It's at Her Financial Help on both places. And then I have a website, www.herfinancialhelp.com.
Okay.
There's a contact me form. You can also just reach out to me, Facebook Messenger. Most people message me on Facebook if they don't have my personal contact.
Awesome.
So,
well, thank you so much.
Yeah.
I appreciate you coming in. We'll have to get you back on.
Yeah.